For most of modern American history, there was an unspoken promise at the center of the middle class. Work hard, save money, buy a home, build stability. And for decades, millions of people actually believed that promise because it was visible everywhere around them. Your parents bought homes. Your grandparents bought homes. Ordinary people with ordinary jobs somehow managed to own property, raise families, and slowly build wealth over time. But now something feels broken. People with decent salaries are living with roommates into their 30s. Couples making six figures are getting rejected for mortgages. Entire neighborhoods are filled with houses nobody local can realistically afford anymore. Rent keeps rising faster than wages. Down payments feel impossible. And even people who finally buy homes often discover they're now trapped inside decades of debt at prices that barely make sense. The strange part is this didn't happen overnight. America didn't suddenly wake up one morning unable to afford housing. This happened slowly, systemically, almost invisibly. And the deeper you look, the more uncomfortable the question becomes. What if homes stopped being homes a long time ago? What if they became something else entirely? Because the modern American housing market no longer behaves like a system designed primarily to shelter human beings. It behaves like a financial machine. And once you understand that shift, almost everything happening today starts making disturbing sense. In 1950, the average American home cost roughly 2 times the average annual household income. Today, in many major cities, it's 6, 8, sometimes even 10 times annual income. That difference changes everything. A generation ago, a single income could often support a mortgage. Today, even dual-income households struggle. Not because younger people are uniquely irresponsible, not because everyone is wasting money on coffee or subscriptions, but because the math itself changed. And the math changed faster than most people emotionally realized. For decades, wages rose slowly while housing prices accelerated aggressively. At first, it seemed manageable. Then came the credit expansion era. Cheap debt, low interest rates, easier borrowing, financial engineering. Suddenly, Americans could bid more for homes because banks were willing to lend more money. And when more money floods into a limited supply of houses, prices rise. That sounds obvious, but the psychological consequences were massive. Homes stopped being viewed mainly as places to live. They became investment vehicles. Parents began telling children that real estate was the safest path to wealth. Politicians became obsessed with protecting rising home values because millions of voters depended on them. Investors realized housing could outperform many traditional assets. Banks earned enormous profits from mortgage debt. Entire local economies became dependent on perpetual real estate appreciation. A strange incentive structure emerged. Everyone benefited when prices went up, except future buyers, especially younger ones. And that created one of the most important economic divides in modern America. Not simply rich versus poor, but owners versus non-owners. Because once housing becomes an appreciating financial asset, affordability itself starts becoming politically inconvenient. Think about the contradiction. Whenever home prices rise dramatically, headlines often describe it as good news. Homeowners feel wealthier. Property investors celebrate. Politicians boast about economic strength. But rising housing prices are only good news if you already own property. For everyone else, they represent a moving target drifting farther away. And over time, this transformed housing from a basic life milestone into a source of social anxiety. Especially after 2008, the financial crisis should have been a warning. The collapse exposed what happens when housing becomes excessively financialized. Millions lost homes. Entire neighborhoods were devastated. Banks failed. Families were wiped out financially. For a brief moment, it seemed like America might fundamentally rethink housing. Instead, something else happened. Interest rates were slashed to historic lows, and those low rates stayed around for years. That decision stabilized the economy, but it also unintentionally inflated asset prices across the board, especially real estate. Cheap borrowing made homes more expensive. Because when monthly payments become artificially manageable through low rates, buyers can stretch further. Sellers respond by raising prices. Investors pour into the market chasing returns. The result wasn't cheaper housing. It was more expensive housing financed through cheaper debt. And this is where the modern housing crisis becomes psychologically brutal. People often think they're competing against other families. In reality, they're competing against an entire financial ecosystem. Private equity firms began buying single-family homes at scale. Institutional investors discovered suburban housing could generate steady rental income. Short-term rental platforms transformed homes into income-producing assets. Wealthy individuals used property as inflation protection. International capital flowed into American real estate markets. Homes increasingly became containers for capital, not just places for human life. And unlike ordinary families, large investors operate with enormous advantages. Cash offers, tax advantages, scale, algorithms, access to cheap financing, entire acquisition teams. In some cities, regular buyers weren't just losing bidding wars. They were losing against corporations. But even that explanation is incomplete, because housing prices aren't rising solely because investors exist. The deeper issue is supply. America simply stopped building enough homes where people actually want to live. And the reasons are incredibly complicated. Local zoning laws restrict density in huge parts of American cities. Homeowners often resist new development because increased supply can threaten property values or neighborhood character. Environmental reviews can take years. Construction costs exploded. Skilled labor shortages grew worse. Material prices surged. Infrastructure limitations slowed expansion. In theory, America is a massive country with enormous land. But economically useful housing supply is concentrated around jobs, infrastructure, schools, and opportunity. And in those areas, building became increasingly difficult, especially in high-demand cities. The result is a pressure cooker. More people chasing too few homes. And once scarcity combines with easy credit and investment demand, prices begin detaching from ordinary incomes. But there's another layer most people miss. Housing inflation doesn't just hurt financially. It reshapes human behavior. People delay marriage because housing feels unstable. Birth rates fall because families cannot afford space. Young adults move back with parents longer. Workers become geographically trapped because moving means losing low mortgage rates or facing impossible rents elsewhere. Friendships become harder to maintain as cities become financially segregated. Housing pressure slowly alters the structure of society itself. And over time, entire generations begin experiencing adulthood differently. You can actually see this psychologically. Previous generations often associated adulthood with progress. First apartment, first home, stability, ownership. Younger generations increasingly associate adulthood with maintenance. Try not to fall behind. Try not to get priced out. Try to survive inflation, debt, healthcare costs, student loans, rising insurance, and housing simultaneously. And housing sits at the center of all of it because shelter is not optional. You could delay buying a car. You cannot opt out of living somewhere, which gives the housing market extraordinary power over people's emotional lives. And then the pandemic pushed everything further. When interest rates dropped near zero during COVID, housing demand exploded. Remote work reshaped migration patterns. Americans fled expensive cities for suburbs and smaller metros. Investors accelerated purchases. Construction disruptions reduced supply even further. Then something extraordinary happened. Prices surged at one of the fastest rates in modern history. People who already owned homes saw enormous wealth gains almost overnight. People trying to enter the market watched affordability collapse in real time. And then came the second shock. Interest rates rose sharply. Now, logically, higher rates should reduce prices significantly. But in many markets, prices remained stubbornly elevated. Why? Because existing homeowners became locked into ultra-low mortgage rates from previous years. Millions of Americans refinanced around 2 or 3%. Selling those homes now would mean replacing them with mortgages at far higher rates. So people stopped moving. Supply tightened even more. The housing market effectively froze. Buyers faced brutal monthly payments due to high prices plus high rates. Sellers refused to list because giving up cheap debt made no financial sense. A strange paralysis emerged. And underneath it all sits a painful reality many people don't want to say out loud. The American dream increasingly depends on timing, not just effort. Two people can work equally hard, make similar salaries, and behave responsibly, yet end up in completely different financial realities simply because one bought property before prices exploded. That creates enormous social tension because modern societies are built around the belief that effort should produce progress. But when core assets inflate faster than labor income for decades, wealth starts concentrating around ownership itself, not productivity. Ownership. That changes how younger generations view capitalism, fairness, and the future. And politically, this becomes dangerous because governments face a nearly impossible balancing act. If housing prices collapse dramatically, millions of homeowners lose wealth, banks face stress, consumer spending falls, and the economy weakens. But if prices continue rising faster than incomes, younger generations become permanently locked out of ownership. Either direction creates instability. So policymakers often choose the least immediately painful option, managing the crisis slowly instead of solving it structurally. Which is why housing discussions in America often feel strangely circular. People debate interest rates, foreign buyers, zoning laws, Airbnb, corporate landlords, immigration, construction costs, Federal Reserve policy, and all of those factors matter. But beneath all of them lies the same uncomfortable truth. America built an economy where rising housing prices became financially necessary for millions of existing owners, investors, banks, pension funds, and local governments. The system became dependent on appreciation, which means true affordability can actually threaten parts of the system itself. That's the contradiction at the center of modern housing. The thing people need most for stability became one of the economy's primary speculative assets. And once that happened, housing stopped behaving like a normal consumer good. Because nobody wants their television price doubling. Nobody celebrates unaffordable groceries. But with housing, rising prices became culturally normalized as success. Even though those same rising prices quietly hollowed out access for future generations. And this has consequences far beyond real estate. When housing becomes too expensive, people become more risk-averse. They delay entrepreneurship because losing stable income becomes catastrophic. Workers tolerate worse conditions because relocation costs are overwhelming. Economic mobility declines because opportunity clusters become inaccessible. Expensive housing doesn't just drain bank accounts. It reduces freedom. And maybe that's why the issue feels so emotionally heavy for so many people. Because beneath the economics is a deeper fear. A fear that stability itself is disappearing. That ordinary life milestones are becoming luxuries. That the future is increasingly designed for asset holders instead of workers. And whether fully accurate or not, millions of people feel this instinctively every month when rent leaves their account. When mortgage calculators become absurd, when starter homes somehow cost nearly $1 million, when entire salaries disappear into shelter before life even begins. The hardest part is that there probably isn't a simple fix. Building more housing helps, but takes years. Zoning reform helps, but faces political resistance. Lower rates can stimulate affordability temporarily, but also risk inflating prices further. Higher rates cool demand, but crush buyers with financing costs. Restricting investors may help locally, but doesn't solve nationwide shortages. Every solution collides with another part of the system. Because the crisis didn't emerge from one mistake. It emerged from decades of incentives compounding together. Cheap money, restricted supply, asset inflation, political incentives. financialization, stagnant wages, speculation, demographic pressure, institutional investment, all layered on top of one another over generations. And now America finds itself in a deeply strange situation, one where homes are simultaneously everywhere and increasingly unattainable, where the economy depends on high property values while society suffers because of them, where millions of homeowners fear prices falling while millions of non-owners fear prices never falling. Two completely different realities living inside the same country. And maybe that's the deeper story here. The housing crisis isn't just about houses. It's about what happens when a society slowly transforms basic human necessities into financial assets first and social foundation second. Because eventually, people stop feeling like participants in the economy. They start feeling like renters inside it. And once enough people feel that way at the same time, the problem stops being just economic. It becomes existential.